Hi, I'm Debi Peverill from Painless Financial Training Group, and this is the annual video we do. This one is on the Nova Scotia TD1 form for 2025. I would encourage you to watch the federal one first because a lot of the same concepts are explained. And you have to, if you live in Nova Scotia, you also live in Canada, so you've got to do the federal one as well. So the provincial TD1 form, it's a 2-page form, front and back. It starts off with your name, your date of birth, your address, social insurance number. All information that you should be able to put your hands on pretty easily. The first box then, which may be pre-printed, sometimes it is, it's $11,744, which is your personal exemption for 2025, assuming your income is below $25,000. If your income is not below $25,000, then there is some proration involved because the actual exemption, if your income is $75,000, is only $8,744. So there's $3,000 between those two exemptions. You get the highest one if you earn less than $25,000. You get the lowest one if you earn more than $75,000. So the way it works, you take the base amount of the $75,000, you subtract your income, you multiply whatever you get by 6%. Okay? That is the base claim. So for example, if your income is $50,000, you're right in the middle here between the $25,000 people who get the big exemption and the $75,000 people who get the lower exemption. You take $75,000 minus the 50, that is $25,000. Multiply that by 6% is $1,500. So your base claim is the $8,744 plus $1,500. Okay, $9,981. If you really don't care to mess around with it, just leave your claim at $11,744 and you might owe a little more tax when you file your return. Next box is your age amount. Doesn't apply to you unless you are over the age of 65 by the end of 2025. You can ignore this box. If you are going to be over 65 by the end of 2025 and you earn $30,828 or less, then the claim is $4,269. We have the same thing going on with this supplement. Box 2.1 is a supplement for people whose income is under $25,000. They get a bump. If their income is between $25,000 and $75,000, there's a worksheet that'll allow you to calculate if there is a supplement available to you for this deduction. So the proration, your estimated income less the $30,828, multiply it by 15%, subtract from the $4,268, and you get your age credit. A lot of fooling around for a few bucks here, but the form, fill in the blanks and do the math. Other boxes on this return. Box 3 is pension income, and this is pension income other than CPP, OAS, GIS. So this is pension income from someone other than the government programs. The amount is $1,173 that you're allowed to deduct. So if your income is, pension income is actually less than that, if you're only getting $500 a year in pension income, then you can only have this exemption for $500. But if your income is more than that, you've got $1,173 you can claim. Tuition. Tuition only kicks in once you've got over $100 in a year of tuition, and you should figure out roughly what you think your 2025 tuition is going to be. So calendar year 25, and that number goes in box 4. Nova Scotia also has something different from the federal government in that we still have a credit for full-time or part-time university attendance. For full-time, you get $200 of credit for every month you're full-time. You get $60 for every month that you're part-time. So there's a place to put that, box 4. If you're eligible for the disability tax credit, so you know this because you've sent forms to the government and they've approved your disability tax credit application. If you are eligible for 2025, then in box 5, you should put $7,341. Box 6. Do you have a spouse that you support? So the income differences here, this, complicated. Basically, if your spouse's income is less than $874, then you get the full claim. If your spouse's income is $8,744 minus the $874, then we get into the amount of the deduction you can actually claim. And there's a worksheet for it. So basically, if your spouse is earning income, it is entirely possible you're not able to claim them. They're not a dependent in this way. This is for spouses whose income for the whole year are under $8,744. And if that is the case, then using box 6.1, you can do the proration to figure out exactly what you can claim. And again, you're estimating, right? You're estimating what the income will be for somebody for a year that's just getting started. Box 7 is one of the ones we get the most questions about. If you have a child but not a spouse. So if you're married, this box doesn't apply to you. If you have a common law partner, this box doesn't apply to you. This applies to people who are what we call single parents. So you have a child under the age of 18, you're getting the same exemption for them you would get for a spouse. So you take the kid's income, you subtract it from the exemption, and you know the amount that you're able to claim. So you can't do it if you're married, you can't do it if the kid has sizable income. There is a supplement, of course, box 7.1. This is for you if your income is under $25,000 and you are supporting a child. You won't be paying any tax if your income is under $25,000 and you have your own deduction and a dependent deduction. You won't be paying any tax. Box 8 is the caregiver amount, and this applies in this case to a parent or a grandparent living with you if their income is less than $13,677. And it's pretty hard for their income to be under that number if they are over 65 because they're getting OAS and CPP. And the OAS is almost $10,000. So that caregiver amount doesn't apply as often as many people think it should. Box 9 is the infirm dependent who wasn't claimed in box 8 because this person isn't a parent or grandparent living with you. Their claim, this is for an infirm dependent that wasn't claimed in box 8. Okay? Same income restrictions. You have to work to get the worksheet. You have to do an estimate of that dependent's income and figure out if you're going to be able to claim the caregiver exemption. Box 10 is what's transferred from spouse. If your spouse is over the age of 65 and they don't need their age exemption to bring their income down to a point where they don't pay tax, they can transfer that age exemption to you. Same thing with that pension deduction. If they don't need it, it can be transferred to you. Where this is more likely to happen is if you have a spouse who's full-time in university, they can transfer the tuition of $5,000 to you. Assuming they don't have any income, right? Again, this is dependent people who can't use up their exemptions, so they're giving them to you. The disability amount is a common one that's transferred. Box 10 is about transferring from a spouse only. So a spouse with a disability credit they can't use can be transferred to you in box 10. Box 11 is to do with dependents. So this would be children who are in university and can transfer a tuition amount to you. They can do that to a maximum of $5,000. A child who is dependent on you and can't use their disability tax credit can also transfer that to you. So box 11 is amounts transferred from dependent, whereas box 10 is amounts transferred from spouse, but it's the same idea. Dependents who cannot use their exemptions can give them to you. So we add all this up and we put the total in box 12. The idea here, again, you've maybe done some estimating if you're working with the caregiver amounts or dependent amounts, and that estimating is based on figuring out how much income somebody is going to earn in a year that is just starting. So some people choose not to put those caregiver amounts on their TD1 form, and then if they do end up being eligible for it at the end of the year, well, they'll get a bigger refund than having less money taken off their tax and then finding out come the end of the year that their dependent made too much money and they don't have that credit which they put on their TD1, so now they're going to owe some more tax. A couple other things, if you have more than one employer, there's a box there to tick, and the important thing there is to know you can only claim these credits once. So if you have a job for 6 months and then you quit and get a new job, you've already claimed all those credits in your first employer. You can't claim them again. Put zeros in all the boxes on the second employer's form. Tick the box on the back that you've already used them, and that'll be a better result. Otherwise, you're going to claim those credits twice from your paychecks, and then when you file your tax return, you're going to owe money because you can only claim them once on your tax return. This applies to people who have a full-time job and a part-time job, or many part-time jobs. They can only claim those credits once. Non-residents, I always tell non-residents to seek professional advice. There are too many things to talk about in a video to go over all of that. If you want additional tax taken from your income, you can do that. There is a place to put that. And there is a form for reductions of tax, the T1213. So this is the video about the provincial form. You should also look at the federal video to make sure that you're filling out both of those forms correctly and give them to your employer so the right amount of tax is deducted from your paycheck.